Stocks plummeting on Wall Street today. The Dow handing in its worst day of the year, falling more than 700 points. And check out the 10-year yield, holding 1.19%. Just 2 weeks ago, your next guest said 1.25% was the key level to watch for yield. So now that we've crashed below that, where are we headed from here? Let's go off the charts with Chris Verrone of Strategas. Chris, take it away.
Hey, Courtney, how you going? So, listen, I think going through 125 is certainly a psychological break of what people perceive to be a very important level. But let's keep things in perspective. Yields peaked at 175 in March. They were something like 50, 60 basis points at this point last summer. That 110 to 112 range is the 50% midpoint between those two levels. So I think it's early to say this has been some apocalyptic breakdown here. I do suspect yields ultimately bottom somewhere in this 110, 112, 115 zone. We have seen sentiment shift dramatically over the last number of weeks, from inflation fears just a month ago to growth fears and COVID fears right now. So I think the sentiment on the street is changing. That's helpful, and I think ultimately putting a low in on yields. As far as what this means for equities, I want to show you an important slide. This is something we've been talking about in our work over really the last month or two, that the correction that we saw in equities today really can be traced back many weeks or many months ago. The average stock, the average Russell 1000 stock, is actually already down about 10% from the high. So there's been weakness under the surface for a while. Industrials are down something like 10. The average bank stock is down about 10 as well. If you go to even some of the weaker pockets of this market, the average material stock down about 13, average discretionary stock down about the same, average energy stock down about 16. So, this correction is not one day old. A lot of these groups, the average issue really peaked about 2 months or so ago. So if we put this in context of the broader S&P, and several have mentioned it, Guy, you talked about it, Dan, you talked about it, that 50-day moving average has been big support along the way. I'm not convinced it's going to ultimately hold through this summer. The 200-day is about 38.95. It's adding about 5 points a day. I do think ultimately the S&P and the 200 will meet somewhere around 4,000 over the next month or two. So what do we want to own in that environment? And this is almost going to sound silly, but I think the best defense here may actually be some offense. The pockets of the market that have already corrected are frankly pretty oversold under the surface. I want to show you the industrials. This is the XLI, and that bottom panel are the flows into and out of the XLI. You've really seen complete liquidation already over the last several months, huge outflows from XLI. The correction here has already happened. I think if we get another leg lower in the broader market, it's the big tech weights, it's the big FANG weights that get you there. It's the offensive cyclicals like industrials that may actually prove to be defensive this time around.
Thank you very much, Chris, for breaking that down. The move on the 10-year getting a lot of attention today. Let's trade it. Tim, what do you make of the moves today and what the bond market is telling us?
Well, I mean, first of all, here's a PSA for when yields eventually get to 175 or, God forbid, 2%, folks. This is a good thing. It's not reason to jump out of windows. And it's extraordinary that that's also where we were. But so look, if Chris is right, 112 to 115, or maybe even here, Jeff brings up Carter's note. Look, either way, who's been most highly sensitive to the move in rates? It's been banks. We've come through an earnings period where people forget the credit quality in the banking sector is as good as it's been in a long, long time. I'm not going to, say in my lifetime, but who knows? And also what the banks have also gone through in terms of their ability to pass capital standard tests and give more back to investors. Also just a trend we've seen in bank earnings over the last 4 or 5 years, which is that they don't trade well when they get the earnings announcements. And as you start to sort through here, I think you're going to see a lot of the banks start to rally. So look, after all this pain, both in banks, exactly Chris's theme, some of these places to play offense to me are financials. Industrials, I'm not sure I'm ready to go there because I think there's still going to be a lot more concern around growth. I don't think the Delta variant concerns go away for another 4 to 6 weeks. But I do think banks have priced in a lot of pain, and you've gotten reaffirmation of credit quality and their capital markets plans.
Guy, what do you make of the charts that Mr. Verrone brought us?
It's a 10-year, which is fascinating. Chris was on a Thursday, and he said that the 10-year was probably going to trade down to 1.25, hold and bounce. And quite frankly, that's exactly what happened. If you do remember, traded down to 125. 2 trading days later, 10-year yields were 141. So that was a prescient call. I didn't see this move down to 119 coming. I don't think Chris necessarily did either. But what he said then holds true now. You're still talking about an upward sloping moving average, which typically it bodes pretty well if you think rates are going to go higher, which I do. So didn't see this one coming, but I do think rates go higher from here.
Shepard Smith here. Thanks for watching CNBC on YouTube.